where compliance becomes daily practice, managing the flow of money. As we continue into Chapter 3, we now move from tracking property management activity into the day-to-day handling of money. This is where most compliance failures occur, not in theory, but in execution. Property management trust accounts are active every day, processing rent, deposits, fees, and expenses. Because of this constant activity, ADRI places heavy scrutiny on how these accounts are managed. Under ARS, paragraph 32-2151, brokers must properly receive, account for, and safeguard all client funds. In property management, this obligation is continuous. Every rent payment, every deposit, and every disbursement must be documented and traceable. The Broker Audit Declaration, BAD, specifically evaluates whether brokers have systems in place to track this activity accurately. This section builds directly on Section 3.1. Once you know how many properties you manage, the next question becomes, how are you handling the money tied to those properties? Receipt requirements. Documenting every dollar. In the first step in trust account compliance is properly documenting funds as they are received. Under ARS, paragraph 32-2151(b)(1), brokers are required to provide a receipt for all monies received. This requirement applies to tenant rent payments, security deposits, application fees, if applicable, owner contributions or reserves. A receipt creates a clear record of who paid the money, how much was paid, when it was received, what the funds are for. For example, a tenant in Glendale pays $2,000 in rent. The property management company must issue a receipt documenting that payment. Whether the payment is made by check, online portal, or cash, the documentation requirement remains the same. This may seem simple, but failure to consistently issue receipts is a common audit finding. Without receipts, there is no clear starting point for tracking funds, which creates risk throughout the entire accounting process. This ties directly into fiduciary duty principles. Every dollar must be accounted for from the moment it is received. Journals and client ledgers. Tracking the movement of funds. Once funds are received, they must be properly recorded and tracked. This is done through journals and client ledgers. A trust account journal provides a chronological record of all transactions within the account. It shows deposits, withdrawals, and balances over time. A client ledger, on the other hand, tracks funds for a specific client or property. It provides a detailed breakdown of all activity related to that owner or tenant. For example, a Phoenix brokerage managing multiple properties will maintain a journal showing all activity across the trust account, separate ledgers for each property owner, tenant-specific records for rent and deposits. These records must align at all times. The journal, ledgers, and bank account balance should all reconcile with each other. Under ARS, paragraph 32-2151.01, brokers are required to maintain accurate and complete records. If journals and ledgers are inconsistent or incomplete, it creates immediate compliance issues. A common mistake occurs when brokers rely on bank statements alone. Bank statements show activity, but they do not provide the detailed breakdown required for compliance. Journals and ledgers fill that gap. Monthly reconciliation requirements. Verifying accuracy. One of the most critical requirements in property management trust accounting is monthly reconciliation. This is the process of verifying that all records match and that no discrepancies exist. Monthly reconciliation involves comparing the trust account bank statement, the trust account journal, all client ledgers. These three elements must balance. If they do not, the broker must identify and resolve the discrepancy immediately. For example, a brokerage in Chandler completes its monthly reconciliation and discovers a $1,500 discrepancy between the bank balance and the client ledgers. This could be due to a missed entry, a duplicate transaction, or an error in recording. Regardless of the cause, it must be corrected before moving forward. Failure to reconcile accounts regularly is one of the most common audit violations. It allows small errors to grow into significant problems over time. ADRI expects reconciliation to be performed monthly, consistently, and accurately. This is not just a best practice, it is a fundamental requirement of proper trust account management, broker review and signature obligations, supervision in action. Reconciliation alone is not enough. The designated broker must review and approve the reconciliation process. This is where supervision becomes visible. Under AAC R4 281103, the broker is required to actively supervise all financial activity, including trust accounts. This includes reviewing reconciliation reports, verifying accuracy of records, ensuring discrepancies are resolved, documenting the review process. In many cases, this involves the broker signing or electronically approving monthly reconciliation reports. For example, a Scottsdale brokerage completes its monthly trust account reconciliation. The designated broker reviews the reports, confirms that all balances match, and signs off on the reconciliation. This creates a documented record of supervision. Without this step, there is no proof that the broker is overseeing the financial activity. Delegating reconciliation to a bookkeeper or property manager without review is a common mistake and a significant risk. A key legal principle tied to this requirement is found in ARS paragraph 32-153, which allows ADRA to discipline brokers for failure to supervise. Even if the reconciliation is completed correctly, failure to review it can still result in a violation. Supervision must be active, not passive. Bringing it all together, property management trust account compliance is built on 4 key pillars: proper receipt of funds, accurate record keeping through journals and ledgers, consistent monthly reconciliation, and active broker oversight. Each step builds on the previous one. If receipts are missing, tracking fails. If tracking fails, reconciliation becomes impossible. If reconciliation is not reviewed, supervision breaks down. The broker audit declaration is designed to uncover these weaknesses. A brokerage that can demonstrate strong processes in each of these areas is far more likely to pass an audit without issue. As we move into the next section, we will examine property management agreements and tenant relationships, where financial responsibility meets contractual obligations. Online discussion. Why are receipts required for all funds received in property management? Answer. Receipts create a documented record of funds received, ensuring transparency and providing a starting point for tracking money through the trust account system. What is the purpose of maintaining both a journal and client ledgers? Answer. The journal tracks all account activity chronologically, while client ledgers track activity for specific owners or properties. Together, they ensure accurate and detailed record keeping. Why is broker review of reconciliation reports critical? Answer. Broker review ensures that financial records are accurate and demonstrates active supervision. Without review, the broker cannot prove compliance during an audit.